welcome to the Intersection Magazine podcast. In this podcast issue, we will be discussing Silicon Valley Bank, and what we'll do is we'll be talking about bits of history about Silicon Valley Bank. We'll be sharing some interesting articles that had some insights about why the bank collapsed and the implications. We'll also be sharing some alternatives for those of you that are in Silicon Valley and are looking for alternatives for your startups. Then finally, we'll be going into the local landscape and talking about what exists that's equivalent to Silicon Valley Bank for startups in the interests of developing the greater ecosystem. Thank you very much. So this article was taken from PBS.com, and it's an analysis of why Silicon Valley Bank and Signature Bank failed so fast. And here's how it goes, or is at least a basic summary. Basically, the article talks about how the collapse of Silicon Valley Bank and Signature Bank took place or happened at a very fast pace. And analysts believe that this could be textbook cases of classic bank runs, and bank runs are what actually happens when your customers withdraw their money in massive amounts. That's what a bank run is. Or when depositors withdraw their funds from a bank at the same time. And Silicon Valley Bank and Signature Bank, three of the failures of those banks, at least, are described as second only to the collapse of Washington Mutual in 2008. So most analysts, when they view the collapse of these banks, began to make comparisons with the collapse of the big banks in 2008. And so a lot of analysis that took place during this time of the collapse of these two banks was centered around the possibility of contagion and who was coming next. And as you read or as you watched the events take place soon, of course, Credit Suisse fell into the same category. So the article is asking, what caused this? And especially they were talking about how could this happen when there was an excess of reserves or an excessive amount of cash beyond what regulators normally require. And so they talked about that the most common type of risk faced by commercial banks is a jump in loan defaults, which is known as credit risk. But the article says that this is not really what happened here. And what he says is that two things come into play in this crisis. But there are two types of risk. He talks about interest rate risk and liquidity risk. So in interest rate risk, he talks about banks face this type of risk when the rates increase rapidly within a short period. And that's exactly what happened since March 2022. The Federal Reserve had been aggressively raising rates. It's about 4.5 right now, in a bid to tame inflation. As a result, the yield on debt jumped to a very high rate. And they talked about also the idea that the Treasury notes hit a 17-year high of 5.5% in March of 2023, up from less than 0.5 at the beginning of 2022. Yields on 30-year treasuries have climbed almost 2 percentage points. As yields on securities go up, the price goes down. And so such a rapid rise in rates in a short time cause the market's value to issue debt, whether corporate bonds and government treasury bills began to plunge, especially those that were pegged on long-term, long-dated debt. For example, a 2 percentage point gain in a 30-year bond can cause its market value to plunge around 32%. Silicon Valley Bank has a massive share of assets, 55% invested in fixed income securities, such as US government bonds. Interest rate risk leading to a drop in market value of a security is not a huge problem as long as the owners hold on to it until maturity. And usually, what happens is, if the interest rates change or rise, if you hold on to your securities, after a while, if usually 10 years, you'll get back the value of your money. And what the bank usually does, it absorbs the losses and takes care of those over time. But if the owner is to sell the security before its maturity, when the market is of lower value, then the loss and the unrealized loss becomes an actual loss. This is what SVB had to do this year, as its customers dealing with their own shortfalls began withdrawing their deposits, while even higher interest rates were expected. And so this is what usually brings in the liquidity crisis, which is the second point we're talking about. We started talking about first interest rate risk. And the other thing I think that's interesting is the role of the Federal Reserve. But what experts are saying is that even if that was the case, that the leadership or the leadership team at Silicon Valley Bank and Signature Bank should have been aware of the level of risks that they were going into. So regardless of what the Federal Reserve was having to do to bring down, or rather to raise the interest rates to curb inflation, the banks should have been aware that they were investing in risky assets, a risky asset base, and that at some point, if depositors chose to withdraw their money, which is what happened in this case, then the bank was going to make losses. So now liquidity risk is that risk that a bank won't be able to meet its obligations when they come, without incurring losses. And there is an example that is given. It says that if you spend $150,000 of your savings to buy a house, and then down the road you need some of all that money to deal with another emergency, you're experiencing a consequence of liquidity risk. A large chunk of your money is now tied up in the house, which is not easily exchangeable for cash. Customers of Silicon Valley Bank were withdrawing their deposits beyond what it could pay using its own cash reserves. And so to help meet its obligations, the bank decided to sell $21 billion of its securities portfolio at a loss of $1.8 billion. The drain on equity capital led to the lender to try to raise over $2 billion in new capital. The call to raise equity sent shockwaves to Silicon Valley Bank customers who were losing confidence in the bank and rushed to withdraw cash. The bank run like this can cause even healthy banks to go bankrupt in a matter of days, especially now in the digital age and in the information age. And some people actually say that some VCs using Twitter and other platforms were responsible for this massive bank run because they brought about a lot of worry for investors who had put money in the bank. Now, the other thing that's interesting is deposits were insured to the amount of $250,000 by the FDIC. And so those who had $250,000 or less were insured, but of course there were more massive amounts in the bank at that time. And those who had more knew that their money might not be safe if the bank were to fail. So apparently there were about 88% of the deposits at Silicon Valley Bank were not insured. Signature Bank faced a similar problem as Silicon Valley's bank collapse prompted many of its customers to withdraw their deposits with similar concerns over liquidity risk. So as the article says that Signature Bank had about 90% of its deposits that were uninsured. All banks usually face interest rate risk today on some of the major holdings because or the federal rate hikes campaign. Apparently, this resulted in a loss of about $620 billion of unrealized losses on bank balance sheets as of December 2022. But most banks are unlikely to have significant liquidity risk. While Silicon Valley Bank and Signature were complying to regulatory requirements, the composition of the assets was not in line with industry changes. Signature had just over 5% of its assets in cash, while Silicon Valley Bank had 7%, compared to the industry average of about 13%. In addition, Silicon Valley Bank's 55% of assets in fixed income securities, with the industry average of about 25%. So clearly their assets were too heavily invested in securities. So the US government's decision to backstop all deposits of Silicon Valley Bank and Signature, regardless of their size, should make it less likely that banks with less cash and more securities on their books will face liquidity shortfall because of massive withdrawal driven by sudden panic. However, with about $1 trillion of bank deposits currently uninsured, the belief is that the banking crisis is not yet over. And this was written way before the collapse of other banks in, for example, Switzerland. Although what interestingly happened was, I believe HSBC bought out the SVB branch in the United Kingdom. So quickly, the United Kingdom government recognized that as the third largest player in the startup ecosystem space, that they needed to bail out Silicon Valley Bank, at least the British version of the bank. Now let's give a bit of history. It says that 4 decades ago, Silicon Valley Bank was born in the heart of a region known for its technological prowess and savvy decision-making. The California headquartered organization grew to become the 16th largest bank in the US, catering for the financial needs of technological companies in the world before a series of ill-fated investment decisions led to its collapse. As a preferred banking for the sector, SVB service was in hot demand throughout the pandemic years. The initial market shock of COVID-19 in the early 2020s quickly gave way to a golden period for startups and established tech companies as consumers spent big on gadgets and digital services. So the pandemic was a good time for those that were invested in Silicon Valley Bank. Many technology companies used SVB to hold cash they used for payroll and other business expenses, leading to an influx of deposits. The bank invested large portions of the deposits, as banks do, and the seeds of this demise were sown heavily in long-dated US government bonds, including those backed by mortgages. These were, for all intents and purposes, safe as houses, but bonds have an inverse relationship with interest rates. When rates rise, bonds fall. So when the Federal Reserve started to hike interest rates rapidly to combat inflation, SVB's bond portfolio started to lose significant value. If SVB were able to hold these bonds for a number of years until they mature, it would receive its capital back. However, as conditions soured over the year, these tech companies, particularly affected, customers began withdrawing their deposits. SVB didn't have enough cash on hand, and so it started selling some of its bonds at steep losses, spooking investors and customers. It took about 48 hours between the time it disclosed that it had sold the assets to its collapse. What triggered the bank run was the idea that most banks only keep a portion of the assets in cash. They are susceptible to a rush of demand from customers. While SVB's problem stemmed from earlier investment decision, the run was triggered on 8th March when it announced a 1.75 billion capital raising. It told investors it needed to plug a hole caused by the sale of its loss-making bond portfolio. Suddenly, everyone became alarmed that the bank was short of capital. Customers were now aware of the deep financial problems of Silicon Valley Bank and started withdrawing their money en masse. Now, unlike a retail bank that caters to businesses and households, Silicon Valley's bank's clients tended to have much larger amounts, which meant that the bank run was swift. 2 days after it announced it would raise capital, the $200 billion company collapsed, marking the largest bank failure in the US since the global financial crisis. The next question is this the beginning of a banking crisis? Immediate concerns of widespread contagion have been contained by the US government's quick response by guaranteeing all deposits of the bank's customers. Financial futures, which allow investors to speculate for price movements, rallied for the US technology sector in response to the guarantees. So the government really saved the day. There had been concerns that if the guarantee wasn't implemented, Silicon Valley Bank holders would not have been able to pay employees, sending ripples through the economy. In terms of stability, they avoided supply chain consequences. Governments around the world, including the UK and Australia, are checking for SVB exposure in the corporate and banking sectors. Now, the advantage that SVB has, or the rest of the world has over SVB, is SVB was involved in what they call niche banking. So it was banking or offering banking services to only a specific number or specific group of people. And so this is why, in a sense, the effects of the collapse of Silicon Valley Bank were limited, although those who in other countries were engaged with SVB services were affected. Now, when you examine the tech ecosystem, you'll notice that lots of companies, from people in Israel to the UK to South America to India, most people have the dream of establishing their companies in Silicon Valley or in the United States. And Silicon Valley Bank was a go-to bank for startups. So this is really why the concern existed. Now, the long-term question is whether SVB's vulnerability to rising interest rates is paralleled in other banks through overexposure to falling bond prices. Now, the global financial crisis, if you remember, was brought about by collapse in housing prices and all those investments that had been placed in mortgage-backed securities. So what the general feeling about this particular time was that if other banks were like SVB were vulnerable to interest rate figures, and of course from interest rates or to the exposure to overexposure to bonds and other trading instruments or trading instruments, then they would be vulnerable. But because most other banks or most other communities are not too heavily invested or affected by interest rates, then in a sense, the effect on the bigger global economy can be stemmed. Now, the article goes on to say that there are immediate concerns in the technology sector. SVB catered for Silicon Valley, backing startups and other technological companies that traditional banks were shying away from. So in a sense, they were providing, as I said, they were providing a niche service. Now, in recent months, the sector has been cutting staff. We've got numbers are out there from Google to Facebook to large number of companies that have been laying off. Now, at a time when all this sector has been going through cutting staff, the collapse of Silicon Valley Bank has meant that the sector has lost one of its strongest supporters. Now, the government of America does not seem to did not get involved with saving SVB. And what the general idea is that those who profited during the good days should also bear the brunt of facing the losses during the terrible days. Now, there's a possibility that a buyer maybe was going to be involved to save the bank, but that was not the case. A little later, after the collapse, U.S. agencies extended a guarantee to cover all deposits at the bank as well as for customers at other institutions. But Signature Bank collapsed over the weekend following SVB's collapse. That was, of course, this article is quite a while back. It means that customers at Silicon Valley Bank will be able to access their money. That was on that particular Monday morning. Shareholders in the bank and some unsecured creditors aren't protected by the guarantees that the U.S. government put in place. Central banks around the world have been raising interest rates over the past year to tame high inflation, with the U.S. moving from near zero to more than 4.5 at a rapid pace. More forecasters expect rates to go higher in the US, the UK, and Australia before stabilizing. The appetite to keep raising rates will now be tested if central banks become more concerned that Silicon Valley Bank's problems will be indicative of a broader weakness in corporate balance sheets caused by rising rates. Now, another idea that emerged from some of these issues was the issue of trust. And I found this after engaging with several prominent people on Twitter. For example, one of the people that I follow on Twitter is a prominent voice in the South America ecosystem. But what he says was interesting. He said that this really is a crisis of trust, and that there was a need to inject a deeper sense of trust in the system and those that are in charge of the system. Now, I found some other useful information that you will appreciate. And this is written by someone on LinkedIn called Harwig Springer. And he suggested 7 Silicon Valley Bank alternatives for startups. So if you look him up, Harwig Springer, and look up the article 7 Silicon Valley Bank alternatives for startups. The first bank, he says, is Mercury Bank. The second bank is Grasshopper Bank. And Grasshopper Bank is the best for venture and SBA lending, or small business administration lending. And it's venture-backed. Novo Bank is the fourth one. It's great for e-commerce and small to medium businesses. Lily Bank is also listed as an alternative. It's best for service-based businesses and consultancies. Axos Bank is 6, which is good for brick-and-mortar small businesses. Capital XYZ is best for high-yield demand businesses. So that is for those who are in the Silicon Valley area or in the US for that matter and are involved in startups. Now, on the local scene, if you noticed Uganda, for example, if you studied the ecosystem, some of our biggest gaps are, for example, in legislation. And right now there's a push to put together a startup act that's ongoing. And if you are involved in the Ugandan ecosystem, your inputs are welcome. The second major vulnerability we have in our tech ecosystem is, of course, with VCs, venture capital, and angel investing, and the limited partner space. And also covering that is also the whole issue of banking. Are there specific banks that cater to our startups or small businesses? What kind of tools do they offer? What kind of funding exists? Or do we all have to go look to the West and to Silicon Valley for funding? Now, what normally happens is the startups can access funding through the major ways through competitions. You bring a solution to a competition funded either by Stanbic or NSSF or JICA. The Japanese have been funding the space for a while, or maybe through hubs such as Hive Collab, Outbox Hub, Innovation Village, going through directly the hubs to access funding through competitions. But I found two useful banks. One of them I came across by accident. They were looking for people who specialize in Linux systems for their bank, but the bank is called EFC Bank, and I looked at four basic services they offer. They have a school improvement finance service, they have a woman market trader loan, they have a home improvement loan, and the second or most important one is called a business loan for launching startups or for growing existing businesses. So I found this interesting that this particular bank has a specific instrument for startups. The second bank I found is Uganda Development Bank, which has what they call the SMEs Kazi loan. Then they have a Women Prosper loan, and then they have a Youth Startup loan, and then they have business advisory services, as well as a business accelerator. Now, the business accelerator has a range of services and also different funding platforms or loans available for those starting businesses or for those seeking to expand their businesses. Now, Uganda Development Bank has its content is online, so you can find this information online. I found it interesting that they cater to women because that's a vulnerable group, and of course they're taking care of youth also and seeing the value in startups. So those are the two major banks that I think are doing big things for the startup community and the ecosystem in Uganda. Thank you very much.